Good afternoon, subscribers, and you join us here on a Friday, and we've just had a tremendous look at multiple choice questions, getting the most out of multiple choice, thinking about privatization, nationalization. Henry, the future Wolf of Wall Street here, the Wolf of Lobley Hill, and now we're moving into looking at these market failure diagrams, and we've been looking at these positive and negative externality diagrams, and now we're going to have a little bit of a look at the remedies for those. So before we get into that, we're just going to go over some of the diagrams that you probably did last year, but also for our new colleagues in class, this will hopefully give them the knowledge that they need in order to move forward. So two diagrams specifically I want us to think about today will be tax and subsidy. So when we're thinking about taxation, Dylan, when we're thinking about taxation, does that raise costs of production or lower costs of production? Correct, thank you. So taxes will be raising costs of production. Okay, and Dylan, if I may direct this question to you once again, when we're thinking about costs, are costs represented by the demand or the supply? Thank you. Top form, Dylan's on top form today, ladies and gentlemen. Supply. Okay. Whereas a subsidy, what's a subsidy, please? Nathan. Thank you. So you've two birds there, ladies and gentlemen, and one stone. So subsidies lower the cost of production or reduce the cost of production. But again, Nathan, because we're talking about costs, we're therefore thinking about the supply, correct? And indeed, Scott, if we think back to what we did last year, supply will actually, when we're talking about the supply curve, it will actually shift. Yes, so the key point is it's a shift. It's not simply a movement up and down the supply curve, because we know that that is only caused by one thing and one thing alone, and that one thing, favour, is change in price. Thank you. Thank you, Henry. So supply in this case will shift. And obviously, supply in this case will also shift. Now, supply in this instance, Sean, will shift to the direction left. Thank you. And this will be to the right. Okay, so we're going to just draw two diagrams just adjacent to one another. So don't need to be too big, really. P and Q, P and Q. So the one that you'll be familiar with from last year would be demand curve 1, supply curve 1, actually that's supply curve 2, and that's supply curve 1. So the demand curve shifts to the left as a tax. P1 to Q2 P. And favour, just with regard to our movement from A to B on the demand curve, so is that a shift of the demand curve or a movement along the demand curve? Correct, so that's a movement along. So the supply curve has shifted and we simply moved along the demand curve to form our new equilibrium at B. And you might find it helpful to just say that S2 is S1 plus the tax. Is that okay, Besa? So the tax increases the cost of production. As a consequence, the supply curve shifts to the left, price is up, quantity demanded and supplied is down. Okay, now Manisha, if I said to you, can you please tell me the incidence of the tax or the size of the tax? Where could we show that? Where could we illustrate that on the diagram?
Would it be A, B, and then
From A to B? Is that what you're saying?
no, but like you have to go down.
You do. So if I started at B,
Yeah, you go down.
the vertical distance down to S1.
Along, yeah, along to the curve, and then you have to go up.
So from here,
Yeah.
point C. So that vertical distance, BC, that is the incidence of the tax, or the tax per unit, if you will. Now, some people who are maybe not as clear as you on that, Manisha, they would say, in answer and in response to the same question, they might say it's AB. But can you tell me why it's not AB?
Well, A, B is just like the equilibrium point between it, so that doesn't really change that doesn't take into account the price.
Henry?
Because AB is just demand, and BC is the difference between the two supply curves.
Right, so that's the key point, I think. Well, we've got two curves, and the reason that one curve has shifted upwards from S1 to S2 is because a tax has been imposed. Therefore, the distance between the two must be the size of the tax. But the key thing is it's the vertical distance, as opposed to simply moving from one equilibrium, Manisha, as you were saying, to the other, from A to B. So yeah, BC is our tax per unit. AD is the size of the tax. Would that be okay to say that? Nathan? Is that alright? AD is the size of the tax? Of course, absolutely. So BC, you could label it, or AD, as long as the vertical distance anywhere between the two, that's absolutely fine to say that is the incidence of the tax.
And is that because like it's supply which is shifting and that's what causes
Correct, yes. So Manisha, if you didn't even, so if you just had two supply curves, S1 and S2, as long as you were saying that's the size of the tax, or that's as long as it's the vertical between the two, it doesn't matter where you highlight it. Yes.
So is like a progressive tax like divergent like that, or is that something different?
So we're going to come on to that actually in this next diagram. Yeah. So I guess it's maybe worth taking that question now. Our learned colleague Sean has just said, just asking about the diverging curves which have been drawn, copied from the textbook. So let's say you think about, give me an example of a regressive tax that we pay in this country. Sean? VAT. And why is it regressive? Prince or pauper? When you get to the till at Tessy's, they don't ask, are you multi-millionaire or somebody who's less well off? We are all paying the same proportion of tax. So if a millionaire goes to the checkout at Tesco with exactly the same basket of goods as somebody who's got a lot less money, they're still paying the same proportion in tax. So it's taking a greater proportion of income from that person who has got less money. Hence, it's regressive. And what's the rate of VAT? In favour? 20%. Correct. Okay, so let's say you had an item which was just £1 at the till before VAT. So you've got to add VAT onto that. So now the price of it, Manisha, is £1.20. So it costs £1, but now you've added tax, and the tax in this case is 20 pence. Yeah? Then you get to the till next day and you've got something which is £2, but you still got to add the VAT to it. So now you've got to pay £2 and 40, correct? Because the 40 pence is obviously the 20% of £2. So now it's £2 plus 40 pence in VAT. So what's happening there to the amount of tax that you're paying? Just the tax. So it was 20, now it's 40, so what's happening? Obviously, beta? The key point is it's increasing. And that is the reason why then, to come back to your question, John, price, quantity, supply. So this might be our good, which is £1, but to that £1 we only have to add 20 pence worth of tax. So that'll be the point on your new supply curve. So that's going to be, let's say that's equivalent to 20 pence increase. And then you get to the next one, that's £2, but now you've got to add 40, so that's a bigger gap going to appear. And so that's the reason why we get this divergence between the tax, S1 and S2, if you will. S1, S2, but that's S1 plus we're adding the tax each time. So that distance is getting bigger. So it's, here we've got parallel, here we've got diverging, and I'll come back to you, Sean, just one second, just whilst this is in my head. So this is, when they're parallel, that's known as a specific tax. In other words, it's fixed, it doesn't change. So that's a specific tax per unit. Whereas this one, as Besa was talking about there in terms of proportions and percentages, VAT, do you know the kind of the economic term for VAT where it's taking that percentage? Okay, so direct taxes, taxes on income and wealth, income tax, inheritance tax, etc. indirect taxes, taxes on goods and services. So VAT is a tax on goods or a service. But this type is known as, you might not have come across this is known as an ad valorem tax, where we're talking about a percentage each time, rather than a fixed amount per unit. Ad valorem tax. So now let's put that diagram into the language of externalities. So instead of having D, Dylan, we will have... No, so that's macro. So this is still micro, and we still want it to be in the language of market failure, positive and negative externalities. The diagrams you just copied out of the book for your homework. Right, okay. So MSB. And then we're going to have our two supply curves, but we're going to have them diverging for a start, like so. And instead of calling them S1 and S2, this time you're going to call them correct. So we're going to call them MPC. So this would be if you were talking about negative externality diagrams. You're going to say MPC and MSC. Q1, Q2, P1, P2. So on our new diagram, which of those positions is the socially optimum, the allocatively efficient, Manisha? Yeah, okay, yeah. So where the arrow points, you're talking about the deadweight welfare loss there. So we're going up from Q1. So we've got a few points there, A, B, and C. So you've got your deadweight welfare loss. Absolutely, you've got your arrow pointing. And level of output. Right, so this is our socially optimum. This is our allocatively efficient level. Now, what sort of market might that be for? What could that be representative of? Scott? Not sure. Nathan, what could that be representative of, that diagram? Under what circumstances might you find that the costs to society are much greater than the costs to the private individual? Or pollution, so go on, yeah, pollution, why? And that local area has nothing to do with the production decision, but they then bear the cost. Okay, good example. Another one, Basic? Okay, favour. That is the same. Any others? Yeah, okay, so go on. Smoking's a great example to use here, actually. So tell us about smoking. Absolutely. So the private cost to the smoker is much less than the private cost to society. I mean, what is the big, sorry, than the social cost to society? What's the big cost to society from smokers? Our national, yeah, absolutely. Health service, having to treat people with emphysema and various other smoking related diseases. Yes, Sean.
If you involve like your marginal benefit curve as well, would that just make the way healthcare loss just bigger?
Bigger, yeah. And for what kind of the analysis that you need to do, you don't need to do that at this point. Not yet, but we will come on to that. And so, can you see from this diagram why the government taxes cigarettes? Dylan, can you see? Not really. So can you see how much of taxation would be going on here if this was a diagram for people who were smoking? It would be A to C. And why would the government charge smokers A to C? Exactly. So what they're doing, in effect, by introducing a tax on cigarettes, is they're trying to raise the private costs of an individual smoker to at least cover some, if not all, of the costs that they're imposing upon society. So they're trying to, obviously, for health reasons, reduce smoking, but they're also trying to get the private costs really to equal the social costs, so that consumption then drops down to Q2. And so you've got to think, well, what are the mechanics of doing that? And one of the mechanics of doing that is to say, right, all smokers, what we're going to do is, because you don't really appreciate the damage that you're doing, we will tax you to the hilt to try and raise your costs so that they're in line with the damage that you're doing to society, so that we move up to this point and move to the socially optimum position. Now, in an ideal world, how many people would you want smoking?
No one.
Correct. But on this type of model, will you ever get to that point? No. Why?
Well, because there's always a private benefit to it. People see private benefit to it, so they'll do it anyway.
Yeah, and there'll always be people, I mean, I don't know, what's a packet of cigarettes nowadays? £12 or something? Extortionate. So there are always going to be people who are going to be buying them, regardless of the price. Yes.
So what does a regressive tax look like income tax? Is that just the same diversion?
In terms of, what do you mean?
Or S2 would look like compared to without income tax? It's like you've got S1, which is like without your income tax. What does S2 like? What does that look like? Is that just the same?
Well, so that wouldn't necessarily be a straight line, would it? Because of the fact that you've got the different thresholds. So that's going to be a sort of stepped, which is not something that you would ever be asked to draw anyway. Right. Okay, right. Well, I think that's a good point at which to stop, really. We'll leave it at that.